Welcome, everyone. Thank you for coming in from coffee. Hopefully, everyone can find a seat, please. We are holding this special panel on Jewish institutions leading the way. And what we're going to do is we have people from a bunch of different organizations coming at this from different angles. And as you heard already today, the topic in general has a number of different dimensions to it. So what we're going to do is we're going to start off by asking each panelist to kind of answer the why question that Julie posed earlier, and why your organization has moved into impact investing, and then moving from there to what we're doing individually at our separate institutions on the impact investing front. So I'm going to use moderator's prerogative to start off myself. So my name is Michael Lustig. I am chair at UJ Federation of I4 Impact Investing. So I'm a layperson there, but I chair a committee that focuses on impact investing writ large and how it really fits across the whole organization. So I'll start off with, as Julie was asking, the why. Why are we doing this? And I kind of see it in addition to the general mission alignment at UJ Federation. I see three main points, and I think this is going to resonate with a lot of people in the room. And my main points are efficiency, sustainability, and engagement. So as we saw, impact investing comes in many flavors along the continuum, encompassing really the span between pure industry and philanthropy. And we saw this on some of those slides that Fran Siegel was showing us earlier. If you're solving a problem through impact investing, you're inherently efficient. You're combining the best aspects of entrepreneurial capitalism, and you're harnessing it for doing a social good. And I'll bring in what Rabbi Greenberg was saying before, so I guess I'm pulling in previous speakers. At the same time, it's also inherently sustainable. So if you're making a one-time limited investment in an enterprise with a social good as part of its mission, what that means is that the social good will be achieved as long as that business remains in operation. So it has that sustainability component. And then lastly, impact investing truly resonates with the millennial generation, as obviously as well as with everyone in this room. But as per a U.S. Trust survey that Fran Siegel referred to earlier, and other data, both hard and anecdotal, we're looking at ways to engage our kids and their peers, and this is certainly an incredibly good avenue to do so. So that's the why. In terms of the what, and what we're doing at UJ Federation, I'll speak to my organization, it runs along multiple paths. So we're doing things in Israel where oftentimes what we say is the double bottom line becomes a triple bottom line when you're doing something in Israel. But we run loan guarantee funds for small business creation among disadvantaged populations, and we're actually right now building a crowdfunding lending platform to do that as well and connect millennials in the U.S. with what we're doing in Israel. We've sponsored food co-ops. We have an investment in the Yozma funds that I think you'll hear about on the next panel, which themselves create social businesses. And in New York, we support an open hiring model bakery. We support JLens, of course. And we're on the hunt for a lot of other things, where my committee, I4, is actually comprised of some of the people in the audience, but we're sourcing and evaluating opportunities and acting as an internal consultant at UJ Federation to really bring impact investing throughout the organization and really ultimately infect the whole organization with the impact investing ethos and culture. So with that, I'm going to turn it over to my other panelists, and I think we'll probably just go down the line to focus on, start off with that why and that what.
Well, good morning, everybody. Thank you, Michael. It's really my pleasure to be here. My name is Daniel Bader. I'm president and CEO of Bader Philanthropies. And I would say I'm actually really quite humbled to be here today after hearing the morning so far, and the conversation has been really quite profound. So just a very brief history of our foundation and our family. My mother and my father created wealth starting in the 1950s in the central city of Milwaukee. starting a chemical business in a little garage. That grew quite substantially, of course, and now is a part of Merck globally. Our foundation was established in 1992 based on that wealth, and also based on the values of the family. So my father was in the Kindertransport. My mother actually grew up in South Dakota during the Great Depression. So those values combined along with Jewish values really are a core of who we are as an organization, as a foundation. We grant around $15 million a year, so a relatively small, mid-sized foundation in the scope of things. We started working in Wisconsin and in Israel. These days we fund in 7 countries, including in Europe. Again, very much of it based on family history and family values. Our areas of interest are working with the elderly in aging and Alzheimer's, working in the area of employment, working with youth, and working in the arts. We also work in an area, kind of a vague area that we call social equality, vague by purpose in the sense that we try to work with populations that have historically been discriminated against around the world. So we are an organization that comes from a Jewish family and Jewish values, but we have a soft Jewish identity, and we've been doing that on purpose for a long time in the sense that we, when you come into our foundation, you will very much feel like it's a Jewish place. When you look at our funding, you very much feel like we're a Jewish organization, but most of our grant making is actually done in the non-Jewish community. Interesting, as I was thinking about this morning, that when you walk into our foundation, you will see the Maimonides right on it. First thing you see when you walk in the foundation is the Maimonides 8 levels of charitable grant making or charitable giving. And that has a lot to do with who we are as an organization. So our journey towards impact investing started about 20 years ago. And it started very much from just a pure philanthropy perspective in the sense that we were making grants and still do in the area of workforce development and employment and such areas. And we wanted to really have more impact than what we were doing. So from a perspective of a grant maker and a philanthropy, we could go so far with grants. So when you're trying to work in the area of employment, you can help people in certain aspects. You can help them work through the barriers of employment, so help them get a driver's license. You can help them with training. You can help them with various aspects, but you're really not creating jobs. At the end of the day, we really wanted to create jobs. And that was the same in terms of wealth creation. We could train people to be entrepreneurs. We could put people through entrepreneur classes, but we weren't really creating entrepreneurs. So we had to figure out mechanisms for doing that. And about 20 years ago, the concept of PRIs was a relatively new phenomenon or not practiced very widely. And we started looking at that as a vehicle to really jump the fence, if you would, to jump the fence from the nonprofit sector into the for-profit sector. So that's how we got there. We got there fairly modestly in that respect. And over time, that built. So we started with loans to nonprofit and for-profit organizations around those areas, around employment and wealth creation, investing in minority entrepreneurs, both on the nonprofit and the for-profit side. About 10 years ago, we took a big leap and we decided to add social entrepreneurship in there, and we created a a for-profit private equity company on the for-profit side who still does, a person of color who leads the organization, who leads the company. And that investment over our years has been only $15 million, but it now it's in their third fund, and they raised over $100 million, and they've created a tremendous amount of wealth in the minority community and have helped save jobs. So I think I'm going to stop there. I'm getting the look from Michael, I think. So I'm going to stop there and go on down the line.
Fascination, not
Stop there and go on down the
the
line.
wrong way. Yeah.
Hello, I'm Jerry Rubin. I'm president and CEO of Jewish Vocational Service in Boston. And I think I fall into the category of one of these things is not like the other. We are not investors, we are investees. And I'm going to say a little bit about that. We are the service delivery arm of a 3-way partnership for the first Pay for Success social impact bond in the world, focusing on workforce development and adult education. And let me just say a little bit about the background. I'll say a little bit about the project without getting into too much detail, because there's a lot to say. First of all, Our organization provides services that are education, skills, and careers for economic opportunity for those who have barriers to economic success. We're the largest organization doing this in New England. We were founded in 1938 by Combined Jewish Philanthropies. We became an independent nonprofit in the late 1950s. And we got involved in this work because we wanted to scale our services. As one of the largest organizations doing this kind of work nationally, but in a state and a city which is one of the fastest growing regions of the country with one of the highest rates of income inequality. The demand for our services is enormous, and the ability to raise capital for significant scaling is very limited. And frankly, as we looked around the marketplace to achieve the kind of scale we were interested in achieving, pay for success, social impact bonds, were really one of the only forms of scaling capital we could see. Now, we happen to be very lucky because 2 blocks from our office are located the 2 primary organizations that do social impact bonds in the United States. And we got to work with one of them, which is Social Finance. The other one, Third Sector Capital Partners, is in the other direction, 2 blocks. So we have a bit of an ecosystem in our community, and we were very lucky about that. I'll say a little bit about the project. Our goal was to scale our services, which are basically combining English language and job skills services at various levels of skill and job quality, reflecting the skills that individuals in the immigrant community bring to the job market. We, as I said, partnered with Social Finance and also the Commonwealth of Massachusetts, that is the ultimate backer of. Now, this is the 3rd social impact bond in Massachusetts, the first one of its kind. We raised $13 million from 42 investors that range from philanthropy to institutional investors to high net worth individuals. And we're using those dollars over a 3-year period to provide these intensive services for 2,000 immigrants and refugees in 5 new cities in Massachusetts. These are called gateway cities. They're second-tier cities, like you may be familiar with Lawrence and Lowell. High concentration of low-income immigrants, very little service delivery. So we had the model, we needed the capital. That's where the social impact bond came in. The one other thing I'll say is how this structure works. Without getting into any detail, the basic idea is that investors, the repayment deal is based on increased earnings of our participants as measured by their Social Security wage data, which we now have access to. And that's done over time with a calculus that looks at higher taxes, revenues going to the Commonwealth of Massachusetts. So that's the basic structure without getting into detail. I'll stop there.
Hi, good morning. I'm Charlene Seidel. I'm Executive Vice President of the Leashtag Foundation. It's my honor to be the token woman on the panel. But I'm not the token San Diegan, because actually 2/5 of this panel is from San Diego, where it's always 72 degrees and sunny all the time. So you're all invited to have the next JLens convening in bright and happy San Diego. Yes, exactly, which I'm going to talk about soon. Thank you, Yossi. Great segue. So I represent an independent foundation which was established by a family, Lee and Tony Leashtag, who left 98% of their assets to the community, to this foundation. They were raised in abject poverty, the children of immigrants. They felt like they were the American dream. They were entrepreneurs. They actually had many, many failures before hitting it big. They were the first producers of generic Ritalin, which was a blockbuster, as you can imagine. But they died quite suddenly, and they had no family, and overnight the foundation went from a family foundation to an independent foundation, which meant that we have this sacred responsibility and this incredible honor to actually make the entire portfolio impact investments, to actually look not differently between our corpus and our grant making, but to advance their legacy and advance the mission of the foundation in every possible way that we can. So we started about 10 years ago. We became independent 10 years ago, and our mission broadly is localized in 2 localities. We work on the ground in North San Diego, where the family lived and worked, and in Jerusalem, which we believe is a center for social innovation and the world inspiration of social change. And we had 3 initial steps, The first was we adopted a do no harm policy, and this question came up before, and we thought, well, that's really obvious. We don't want to do anything that's really bad. We don't want to end up on the front page. The front page of the, okay. We don't want to end up on the front page of the LA Times like the Gates Foundation did, about where their investments were actually being counterproductive to the world of their grant making. And we thought it would be easy, but it wasn't as easy as we thought. We've actually ended up getting completely out of emerging markets. There was a question that came up before about state sponsors of terror, human trafficking, and we really can't find emerging market fund that will answer the questions that we had to our satisfaction. It actually hasn't really affected our returns, but it was an interesting byproduct. The second initial step that we took was we decided, well, Israel's a startup nation, it's high tech, why would we be giving all this money away in Israel and not invest in the Israeli economy? And so we brought to our investment committee 2 investments in Israeli venture capital. Our investment advisor at the time, 6 years ago, made us sign off on a disclaimer that they wouldn't be responsible for the results. And today, those investments are the highest performing investments in our portfolio. So, that's how it goes. They're using it as a real example now of their, foresight. And the third thing we did, like every good private foundation, we bought a 67.5-acre agricultural property in North San Diego. We shocked everybody, which was the former poinsettia ranch, the Paul Ecke poinsettia ranch, where the poinsettia was actually grown and marketed for Christmas. So we're turning the Christmas capital of the world into a center of Jewish sustainability and a campus of integrated social enterprise. The 67.5-acre property, leased tag commons, we bought about 4.5 years ago. There's about 1/3 of the property is greenhouse space that we lease to 8 agricultural tenants. 1/3 of the property we use for different community programs, like a co-working space for nonprofits. And 1/3 of the property we use as a Jewish community farm. And I'm happy to answer the question, what's Jewish about farming, during the Q&A. There's a lot Jewish. We've expanded income by about 5 times since taking ownership of the property. We find that with cannabis being recently legalized in California, we're not going to grow it, but we do have the right. But the need for food growing space has actually intensified, and as I heard in a recent study, 4 out of 4 people eat. So that's good for business. So we took those initial steps, and about a year ago, as we were analyzing what we've accomplished, we thought, you know what, we've got to do more. And so we've now made the commitment, inspired very much by the Heron Foundation, which, if you haven't read their investment policy statement, I would really urge you to do so. The way that they describe what they're doing in terms of mission-aligned investing is the most beautiful language and the most inspiring language that I think that you'll encounter. And we've committed, because we do believe in agricultural cycles, and it was wonderful to hear one of my incredible heroes, Rabbi Greenberg, talking about Shemitah, the 7-year Shemitah cycle. In the next 7 years, we're going to be converting our entire portfolio into mission-aligned assets. So right now, we have about 1/4 of the portfolio invested in mission-aligned assets, and we're going to be going to 100% by the year 2023. We're focusing in on, we also hope to be an inspiration for other Jewish foundations to do this. I think this is a wonderful example. For years, I've said there's lots of talk about impact investing in the Jewish world, but I can count the number of foundations actually doing it on one hand. And it's great to see the energy and excitement. I think it's really due to Julie's leadership and the work of this team. We're looking at real estate opportunities, both in Jerusalem and in San Diego. We're looking at business development, economic advancement. I'll leave it at that, but I'm happy to answer any questions. And also, you can go on our website, leashtag.org, to learn more. Thank you.
Okay, Jeremy.
Good morning. My name is Jeremy Pearl. I'm the Executive Vice President and CFO of the Jewish Community Foundation of San Diego. I'm the other part of the two-fifths. Thank you for that, despite my accent. So to answer the question why we've moved into impact investing, we needed to engage into some serious introspection as to who we are. Our stakeholders are 750 families, thereabouts, virtually every major Jewish organization in San Diego for whom we hold funds. We oversee around $340 million. That puts us in the small mid Jewish Community Foundation category. But our grants are in the range of between 100 and 150 million a year. For those of you listening, yes, that is correct. So we give away around 40%, 30, 40, up to 45% of our assets each year. So that makes us the largest grant maker in San Diego. Of any type. It's about 30% Jewish impact, so our footprint is much larger than our asset size would suggest. Our mission is to educate, engage, and inspire. We've always been innovative in looking to expand the value add to our donors. And the question we really started asking ourselves is how we can bring even more meaning to philanthropy beyond traditional grant making. So we're a Jewish values-based public institution. We're donor-directed, so we reflect the philanthropic pulse of our donors. And we asked ourselves how best we could offer new opportunities to our donors and organizations to express those Jewish values and attract donors secondarily, who haven't engaged with us, whether they're next generation or those looking to leverage their grant making through impact. And that's an almost existential threat to all Jewish community foundations and certainly all community foundations to be more than a transaction, goes beyond the scope of today's discussion. So getting to the what do we do about it? We did what any self-respecting public charity would do. We formed a committee. And of course, and the goals were around education. And Julie talked a little bit about education earlier on. And for us, that meant technical education. It meant understanding the space, the choices, and the impact of those choices. And we partnered with JLens, thankfully, quite early on in the process, as a couple of years ago now, to help us do that. That was really critical for us internally. It gave us a national perspective, it gave us a peer perspective, and it gave us a lot of credibility internally in terms of consensus building within our community, not just the lay leader community, but within the community. The real key to us moving forward and not just talking about it was to go out and conduct a survey of our customers, our families and organizations. We have a pretty robust institutional business. So we designed a survey, and it was a very simple survey in partnership with Julie. Really, there were 5, maybe 6 core questions. We sent out over 800 surveys, and we received almost 100 responses. So we were very excited by that level of response, what we heard, not just what we heard, but who we heard from. We had some very detailed responses, including free-form comments from a couple of CEOs of major Jewish institutions, even one of our major secular public museums, which was very informative to us. Unfortunately, we don't have time to share all the details, but suffice to say that we got buy-in, we had actionable information, and that really helped us move from the why to the what and develop a product, and that's what it was about for us. And we decided the best way to do that was to develop a new investment pool, investing across multiple asset classes to complement our existing portfolio of 5 investment pools. We worked very closely with Julie and with our investment consultant, Pavilion. We created this pool to give us exposure to high-impact shareholder advocacy, express our support for Israeli public companies, and the ability to allocate now and in the future to thematic areas of impact through private investments, both debt and equity. We kept the board informed along the entire journey, from scoping through development. And the really nice ending to this story is we just pre-launched this summer. So I'm glad you delayed the conference a little bit so we can have a story here. With $2 million of our own seed capital, thanks to our board's support to give us some initial scale. And we have already attracted some early and donor and organizational funds. We're going to be moving into a more formal donor engagement and marketing phase early in 2018.
Thank you. So actually, Jeremy, you kind of answered part of what I was going to throw to the panel for the next question, which was to discuss any obstacles, challenges, or generational divides that you've encountered and how to really get all constituencies that you need to please on board in order to be successful, particularly when we have heard, I guess, earlier today, concerns about fiduciary responsibility, financial return, things like that. So maybe, Jerry, if you can, because you did something that was a little bit, a social impact bond is a new thing, if you will, in this space.
Actually, before I talk about obstacles, one item that I failed to mention, which I think would be of interest to the audience, is that of the 42 investors, one important partner in the capital raise was Combined Jewish Philanthropies. And what was interesting about that process was that they opened up our deal to their donor-advised funds. And I think we ended up with 5 donor-advised funds that participated in the investment. Our local community foundation, the Boston Foundation, did the same thing. So there were actually a group of donor-advised funds that were investors. Anyway, to obstacles. So there were, and again, I'm speaking about obstacles as a service deliverer, a utilizer of capital, not an investor. But there were, I would say that for our project, there have been 4 primary obstacles that I think are very relevant to any new capital and new types of scaling capital. And they are time, risk, capacity, and sustainability. And I'll just speak briefly about each of them. So 1, time. This deal took too darn long, right? 2.5 years from the time we began talking about it until the time we delivered. Now, let me tell you why that matters. When we first began and did our program design, we were in a situation with 8% unemployment. We're now in a situation with 3% unemployment. Those are not just numerically different, they're qualitatively different labor markets. But our design, which drove all of the investment and return, is not changing because that was done 2.5 years ago. That's too long because the world changes too quickly. Also, we had a change in state administration. We moved from one governor to the other and spent 6 months on the politics of making that happen. And I'll come back to this in a minute. And the risk, we changed national administrations because 2.5 years is a long time. So time, risk. We, because of the delay and how long it took to close this, we actually, I mean, we're a, I don't know now, $17 million organization, but we were at risk of about $1.5 million of our own dollars, which we put out to begin service delivery because the timing didn't work out and the closing was delayed. Now, prior to the election, I thought the risk factors were moderate, but understandable, right? And so did our board. Who would have predicted? So the week that literally the week that our bond went to market was the week that the Muslim ban was passed. And our focus is on immigrants and refugees. So you can imagine I did not sleep well for a couple of weeks. Ironically, the deal was actually oversubscribed within, I think, 4 weeks. And my guess is there were some value statements going on. That would be the only way I could explain that. All right, so that's risk. The third is capacity for scale. So we are scaling at about a 10x level. That's a big jump, right? That means we're moving into 5 new cities. We're working with 2,000 new clients. We had to hire 40 new staff in a full employment economy. We needed data systems that were not bad, but now they couldn't just be not bad. They needed to be flawless. So imagine the capacity. Most organizations in the human service world, in my experience, do not have the capacity to do 10x scaling. So if you are investors and you're interested in making an impact, the delivery entity has to have capacity. It's not just the financing, right? It's the ability to deliver. There is no room for error in this project. We are returning to we've already made 2 investor payments and we plan to make the rest of them. We will be successful, right? There is no room for failure because this is our growth strategy for the next 20 years. So capacity is important. And then lastly, sustainability. This is a 3-year project. We've done a lot of building of infrastructure. I have no intention of rolling it back up when we're done, but there isn't a sustainability model built into the Pay for Success social impact bond model. It doesn't exist. The hope is that a public entity will assume, well, we've got great outcomes, we've proven a model, now we'll just pick it up that way. Or investors will do it. But there actually isn't a way of doing that. That's not part of the deal. That's what we're beginning to figure out right now. So those are some challenges.
I'll say that I'm impressed that you got that done, just because I personally have encountered a lot of inertia that I'm fighting against to get people's mindsets, if you will, changed towards different impact models. So, kol hakavod.
I I just respond to what you said about generational divides, because I think it's a shame that we're overemphasizing, or if we overemphasize this. For us, a World War II generation member of our board was the biggest proponent of moving to an 100% impact investing portfolio. Impact is not a new thing. Maybe we're expressing it in different ways. And there's more maybe education to do with millennials. This is really, really important, but I would also encourage all of us who are Jewish institutions not to only rush into this because we think it'll appeal to the young people more, and rather to lead with our values and to reach out to across the generations that want to see multiple bottom lines. And I think that we'll find a lot of support from multiple generations.
Yeah,
Thanks.
I think, also you had what I'll call the good experience in terms, and the good that we'd expect experience in terms of returns. And I think part of the generational divide and part of the inertia is where people kind of, especially investment committees, view it as if it ain't broke, don't fix it. And here you're presenting something totally new that they're not comfortable with and not used to, even though there's a value proposition there on both the economic side and the mission alignment side. But it's still, in many cases, and it's a little bit different when you have your own foundation and less of a bureaucratic process, but sometimes you still have to fight that inertia, and that's something that I think some people in this room have experienced. I'm getting the hook for time soon, so I just want to open it up to questions from the audience, and I'm sure people do have questions. So please raise your hand and we'll get you a microphone.
Hi, Robert Brown here. I'm an impact investor. I was the head of research at Just Capital, and I'm on the board of List College at JTS, so this all makes a lot of sense to me. So thank you, everyone who's been pulling this all together. I wanted to ask the investors on the panel, if I could, are there singular issues that define the way you think about impact and that prescribe the way you invest? Because impact can mean all kinds of things to all different people. It could be a wandering field, or it can be a very tightly defined field, and I'm just wondering how you think about that.
I'll take it if I can. So you're right, impact does have a wide continuum, and we kind of saw that earlier with the slides, but I think people are mostly familiar with that. I think people define impact, different organizations define it differently, and I think mostly the way they define it is how it aligns with their values and their mission. So if you have a Jewish federation that is doing helping people in need and looking out for the needs of the Jewish community, there's kind of a wide range of what fits under that umbrella. If you have a foundation that's a little bit more prescribed in terms of what their target is, I think whatever is aligned with them would count as impact. And even though things that might be good or might be objectively good or interesting or environmentally correct or whatever it may be, may fall under the broader impact umbrella, I think for each organization, they have to kind of define it as what suits them based on their own approach.
Oh, I understand that. I'm asking what are those specific definitions that maybe each of your organizations follow?
Okay, so do you want to take apart specifics?
I'll just say from a public foundation standpoint, we looked more at our perceived obligation to thread the fiduciary needle and to deliver a product that was very broad-based, one that returned a near market rate of return to a lot of stakeholders, some of whom are fiduciaries in their own right. So to meld those things together, I think it's an excellent question, but in a public charity context was very challenging. And I think the real key for us was to take the secular measures, the secular goals that our secular consultant, Texas Hemaplant at Pavilion, asset allocation, manager selection, performance monitoring, and put them together with the values-based approach that we developed with Julie and JLens over a year. And do that in a diversified portfolio. And that's how we approached it, if I understand the question.
For us, as I said before, we have a do no harm that spans many areas, including human trafficking, climate, environment, state sponsors of terror, et cetera. But then our proactive investments are very aligned with our mission, localized in primarily North San Diego and Jerusalem, real estate and economic development.
A slightly different perspective. The one thing I would point out is that our deal was structured with market returns, and it was intended that way because we were looking to track capital that we otherwise wouldn't be able to attract through other forms like philanthropy. Otherwise, what would be the point? But the actual impact was a clearly measurable human capital return. I mean, I think that, and we had a range of investors with impact from very socially aware impact to barely socially aware, and it ran the gamut because we had a good return.
So I think, for us, we probably categorize it in two ways. One is the measurable and the other is the unmeasurable. The measurable is fairly straightforward. So on the financial side, as was mentioned, we like to have either maybe a near market or low market return. We have to have some return, financial return. That's really important. On the social side, we can count, and we do, the number of jobs that are created. We can look at other aspects of that. But really, at the end of the day, we're looking for some intangibles. And I would say, if I had to put it into one word, it would be dignity. Would be able to get people to feel like they have more dignity in their lives. And you can't put that in a measurement. But I think of some of the housing projects that we've done where we've financed housing where people have gone from unsafe situations, particularly when they're elderly, and going into a safe situation and walking into their apartments and their homes where they are proud of their apartment and there's a sense of dignity. I don't think you can measure that other than just being there and experiencing it and knowing that you did good.
That's a wonderful way to end this panel, actually, so thank you. Thank you all, and we're all around to answer questions for the rest of the day.